Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Gaurav Mehta, CIO Alternatives, SBI Funds Management. He joins us right now on the show for the first time in his new role. Gaurav, good having you. Been a while. Thanks so much for taking the time out.
Thanks, Neeraj. Thank you so much, and good morning to all the audience, and thank you for having me.
The pleasure is entirely ours. So, Gaurav, through your prism, and just for the benefit of our viewers, CIO Alternatives means everything non-mutual fund but equity related, I presume. So, Gaurav, through your prism, how do you look at risk assets from where we are, from the way they are currently perched right now?
Right. So I think this has been a very interesting sort of market complexion of the last 3-6 months, wherein you've seen two things happen simultaneously. I think there has been a growing confidence that the worst of liquidity tightening is behind us, and that's getting reflected in 10-year bond deals across the globe, including the US, India, and so on. And I think post the SVB scandal, you also saw some increase in Fed's balance sheet size. Obviously, a large part of that was to do with emergency lending and so on. But I think broadly, this narrative that the worst of liquidity tightening is behind us is shaping up, and that's leading to some increased flows across risk assets globally. But then the other thing is also true, which is that if you think of confidence in economic growth, that also has come off over the last few months. We track the global money supply growth data very closely, and that data has continued to weaken over the last several months. So money supply growth is not growing anymore, and that in turn should mean that going forward, both inflation and growth should come off. So, amidst this backdrop where on one hand, liquidity related tailwinds or sort of headwinds are behind us, but on the other hand, growth related headwinds are ahead of us. I think this has been an interesting market environment where, a lot of these flows have not gone into pro-cycle assets. They've gone into relatively defensive assets. So US equities, for example, if you think of it, last 2 years are largely dominated by small caps doing well, value stocks doing well, and so on. But the last 3-6 months have been a very different complexion, where again Nasdaq has taken the leadership, growth stocks have come back. So on top of it, the surface looks fine. There are flows and so on, but when you look at beneath the surface, it looks like these flows are still very defensive in nature and not very pro-cyclical in nature. India obviously has been a different story, where all kinds of stocks are doing well. But I think, if you are in an environment where global growth slows down, then I think you'll have some rub off on Indian growth as well. So on the whole, I think to answer your question, yes, there's been a risk-on rally, but it's not as risk-on as it looks on the surface. And we are not believers that, one should chase this risk-on rally. I think there is still this period of adjustment where, we've been going through this period of adjustment for the last 2 years on Indian equities, where we've logically gone nowhere. We've largely been flat. I think that period of adjustment will continue for some more while before we have a more sustainable basis for a sustained up move.
So, Gaurav, very interesting points, and thanks for that opener. Just wondering, so over the course of the next 12 months, if your premise is that one should not chase this momentum as we're seeing currently in risk assets, but over the next 12 months, we very likely will see increased spend from the government, better earnings growth in FY24 relative to FY23 at least. Even if we don't clock in 18 and we come in at 12 or 13, it will be better than the 10% that we clocked in. And if indeed the narrative of interest rates at some point of time in 2024 coming off starts getting priced in, then that is also a tailwind in the second half. So how do equity markets judge it? I mean, do you reckon that there will be a corrective move, or do you reckon that the markets could consolidate? What is the higher probability?
Right. So I think if you think of what's happened over the last 2 years, and for us, valuations play an important role in, shaping our investment decisions. And for valuations, again, different people look at valuations from different perspectives. But for us, the simplest way to look at valuations is to look at equity valuations relative to where the risk-free rate in the system is, which is nothing but the government bond yield, right? And on that spread, right, equity yields versus bond yields, we were pretty expensive 2 years ago. Last 2 years, Nifty has broadly flatlined, right? It's not done much in terms of the absolute price levels. Earnings during that period have caught up some. So when you think of it in PE terms, there's been some compression. And then off late over the last 3 odd months, there's been some reduction in bond yields as well. I think we've seen a 40-50 basis points decline in 10-year bond yields. So that combination of prices, equity prices flatlining, earnings catching up some, and bond yields now starting to moderate has meant that valuations have moderated versus very expensive levels of the last 2 odd years. But still, on a relative basis, it's difficult to make a positive case for equities versus bonds because equity valuations still are moderately expensive versus bonds. So even with the moderation of the last 2 years, you are not out of the expensive zone. And to that extent, in spite of all the factors that you mentioned, our view is that going forward, this consolidation phase may continue. So think of it as a process of adjustment. We are more than halfway through in that process of adjustment, but we don't think that we are out of it yet. So that process may still continue for the next at least a few quarters more. And to answer your question, yes, I think it's more going to be consolidation, like what you've seen over the last 2 years, a broad range, but consolidating within that range, rather than a big breakdown or a big runaway either side.
In which case, Gaurav, I'm presuming by virtue of the fact that since you are heading the alternatives investment piece, and there you typically tend to bat for slightly higher returns as well, how do you plan to generate alpha within the portfolio? I mean, people don't have Nifty futures in their portfolio, so even if the markets consolidate, would you reckon that you are finding pockets which could give you a bigger and better bang for the buck?
Right. So I think on alternatives, we run both PMS strategies, which are concentrated long only bottom up portfolios, and we run a long short strategy on the AI platform as well.
Okay.
On the PMS side, I think the sort of positive aspect is that we are not size constrained, as a lot of mutual fund schemes are, where AUMs are quite draconian. And we run very concentrated portfolios, not more than 20-25 stocks at any point in time. So for us, more than the market beta per se, it's all about identifying those limited 20-25 opportunities which can still continue to deliver irrespective of the market environment. So I think that makes the job a little more interesting. I won't say necessarily easier.
Yeah.
But a bit more interesting. But in terms of pockets that we find interesting today, I think one clear pocket that we've been very positive on for the last few months, and we continue doing that going ahead, is the mass consumption space. And if you track the recovery post the COVID lows, I think it's been a very two-pronged recovery where specifically with respect to the Indian context, you've seen premium consumption do very well, and you've seen exports do very well. And in a way, where global growth was very strong, obviously exports had to do well. But incrementally, the signs are that overall the policy tightness globally is leading to a growth slowdown. In India, also you're seeing lagged impact of all the sort of monetary policy and other sort of tightness that you've seen with respect to policy, which is playing its part on premium urban consumption. But the flip side of which is that if you think of mass consumption, it didn't recover well during the post-COVID recovery for the simple reason that inflation also came up in a big way. And it's not that disposable incomes were rising for the lowest strata of the society. And then when inflation came through, the real spending power actually declined materially. Now, even as broader growth environment is slowing, inflation is slowing as well. And I think that in turn would mean that for mass consumption, the real disposable income will improve because, inflation is ceasing to be a challenge as it was in the past. And then I think, you also alluded a little earlier during the conversation that how this is an election year. You're seeing increased spends on rural infrastructure for that matter. Subsidies are moving higher. Cash prices, cash crop prices have corrected some over the last few months, but broadly they are much better than what they used to be a couple of years ago. I think a combination of those things is aiding rural and mass incomes, and the fact that inflation is coming off is helping further with respect to real spending power. So I think this entire segment where mass consumption, rural consumption, which didn't participate in the recovery so far, is something that is now turning the corner, and I think that stays one of the relatively sort of safer pockets in an otherwise challenging macro environment.
I'm trying to understand, how do you play, if you do bet on this argument of the uptick in per capita over the course of the next 3, 5, 7, 10 years maybe, or even longer? And is it prudent to bet on themes like that with that long a time frame? Not that they will not do well short term, just trying to understand.
No, very clearly, I think if there's ample evidence from the global sort of economies, which is that whenever you cross $2,000 per capita in terms of your GDP, there is a very hockey stick kind of phenomenon that's seen in a lot of discretionary consumption categories. I think India, we hope, should not be any exception. But there again, you need to nuance between consumption also into separate buckets. For example, staples is something where penetration in India is already quite high. So as you keep increasing on per capita GDP, more spend will go towards discretionary than towards staples. So from that point of view, discretionary stands as a better beneficiary than staples on this longer term trend in increased per capita GDP. And then on discretionary, again, you could divide it into two categories. One is the low unit cost mass consumption kind of discretionary categories, and then the second one is the entire premiumization trend. So far, I think the one piece that's doing very well on the discretionary consumption side is the premiumization trend. But I think if per capita keeps improving, then the mass discretionary consumption piece should also come together. So, and again, given the cyclical elements, so sort of the cyclical arguments that I highlighted in favor of mass consumption, I think discretionary consumption where the per unit price is lower, which caters to mass discretionary consumption, is something which we think is very well placed today, not just from this entire structural per capita GDP improvement argument point of view, but also from a here and now cyclical argument point of view, where inflation coming off should help this category.
So
but overall, I think this is a category that you cannot miss if you are an investor in India.
So Gaurav, just to simplify this for the benefit of our viewers, what are those pockets that fall under this bucket which benefit from the here and now as well as the structural opportunity?
So these will be, a variety of categories, but, these could be, for example, footwear. These could be categories like dairy. These could be categories like two-wheelers, anything and everything, that has a discretionary element to it and appeals to the sort of masses. So where, the per unit selling prices, or, for that matter, value fashion retailers and so on. So it's a basket of categories. Where the unit prices are not too high and where there is a mass consumption appeal, but still tend to be discretionary.
Okay. The other pocket that I wanted to pick your brains on is IT. Now, the opinion is always largely divided at most times in IT, but I was looking at the analyst meet of a mid-sized company that did it yesterday, and the key takeaways from there, which probably point towards maybe a recovery not imminent in the second half either. Is it prudent to stay away from IT, or is it presenting value currently?
So, I mean, in general, at least on our funds, we have been underweight on IT for a very long period of time. And I don't see any reason to change that view as of now. We sort of understand that valuations is one argument, that you can paint in favor of IT today, because it's one of those sectors where there is an inherent quality because of high ROE and high cash generation. And then when valuations become cheap, that automatically puts a flow to the sector. But with respect to the cyclical factors, as you rightly mentioned, we think that we are entering a period of global slowdown, not emerging out of it as yet. So I think it may be a bit too early to go bottom fishing in the sector overall. And again, as I said, we are not running strategies on the alternative side, which are very sort of benchmark oriented, right? So we are running bottom up absolute portfolios, and result, we don't necessarily go by what weight the sector has in the index and deciding on underweights and overweights accordingly. We're looking at absolute best 20-25 ideas at any point in time, and we find opportunities which are much better elsewhere than in IT currently.
So where are the largest overweights? I'm presuming that mass consumption would have been one. What else?
I think in general, that entire pocket around whether it's mass consumption or in general discretionary consumption, the point that we discussed on.
Okay. So that's the largest overweight.
Yeah, I think that's a large overweight. And in general, we also are, in spite of the near-term slowdown worries, we are also continuing to hold some of these industrial names. And I do understand that, that space is re-rated quite a bit already, and, valuations are pricing in some of the factors already. But I think if you think of non-linearity in earnings for the next 3-5 years, then, this entire manufacturing theme still has a lot of legs. And I think that looks to be one of the safer pockets if you had a 3-year time frame, even from the current level. So plays on manufacturing, whether it's garment exports, whether it's outright industrial exposure. I think that's something that or whether it's some niche chemical companies, I think that's some pocket that's a pocket that we are largely overweight on, and we do understand that in the near term there might be some ups and downs, but from a 3-5 year point of view, I think that's one pocket that looks relatively safer as well as promising from a side point of view at this point in time.
Okay. My final question, Gaurav, and I buy this. I mean, I'm just saying that I understand this argument about industrials and the punchy valuations, but you yourself qualified it by saying that the non-linearity in earnings will ensure that at some point of time they'll yield returns. I heard you mention that you also have a Longshot Fund too. I'd love to understand, where is it that you guys are negative currently, to the tune of not just being underweight but being downright short? Are there pockets there where you guys believe that in the near term there might be downsides?
So, I mean, the way we run the Longshot Fund is that we still think of it as a long biased fund. And the allocation range is from 0 to 130, 70% or so being the neutral allocation level, versus which we would be at about 60%. So we are still underweight with respect to the neutral equity allocation. The shorts are largely expressed through Nifty futures. So I think there are two pieces that we've built over the years. One is obviously the entire bottom-up stock picking team. I think through a long-only portfolio, which is always 70% invested in this fund, we take advantage of that long-term stock picking skill. And then we've also done a lot of research on top-down asset allocation frameworks over the last few years. And that asset allocation piece, where we look at market valuations, where we look at market sentiment, and where we also model earnings going forward. So that three-pronged approach on asset allocation is what helps us decide whether you should be at 0% at any point in time or 130% at any point in time. And today we, as I mentioned, are closer to 60%, so on the underweight. So, but that asset allocation view is largely expressed through Nifty futures. So in a way, it's a two-pronged approach: a stock selection piece up to 70% of the portfolio that stays uninterrupted irrespective of what the asset allocation call is. And the asset allocation call then is expressed through Nifty futures. So it's a long biased strategy, but in extreme cases, we come down to 0 or go to 130. So the idea is that you should get long only kind returns over long periods over a cycle. But when there are big drawdowns in the market, you should not fall more than half of the indexes fall. So that's how we are sort of trying to calibrate the risk reward on this fund and improve it versus a conventional product.
Got it. Okay. Gaurav, pleasure talking to you. It's been a while, but I'm glad we were able to connect today. I look forward to having you more often on the platform.
Absolutely, my pleasure, and thank you so much for having me again.
The pleasure is ours. And viewers, thanks for tuning into this edition of The Talking Point.